Okay, so the Federal Reserve just cut interest rates. As an investor, you need to know that what happened after that announcement is way more important than the headline itself. We're going to break down the signals, the conflicts, and what this really means for your portfolio. And this is the million-dollar question, right? A rate cut is supposed to be rocket fuel for stocks, but the reaction was, well, it was fractured. We're going to dig into why the big stocks basically went nowhere while small stocks actually fell, and what the bond market is screaming at us. The answers aren't in the cut itself, they're hidden in the reasons for the cut. All right, first things first, let's get the facts straight. The Fed made its move on October 29th, and as you know, in this game, the details are everything. So they delivered a quarter-point cut. We're talking 25 basis points, but here's the real kicker. This isn't a one and done. It's the second time they've cut rates this year, which pretty much confirms we are in an easing cycle. Now the question on every trader's mind is how far and how fast are they going to go?
This move brings the new target for the Fed funds rate, that's the rate banks charge each other for overnight loans, down to a range of 3.75 to 4%. You can think of this as the anchor for borrowing costs across the entire economy, from your credit card to the biggest corporate loans out there.
So why did they do it? Why now? Let's be clear, this wasn't about juicing an already booming economy. Nope. This was a defensive move. It was a preemptive strike against one big flashing warning sign. And you don't have to guess what that warning sign was. They told us. This exact phrase is from their official statement. Now, for a central bank, using words like less dynamic and softer is basically code for, hey, we are seeing cracks in the foundation of the economy, and that foundation is the jobs market. And this isn't just a vague feeling. They're seeing real red flags. Hiring is slowing down, the unemployment rate has started to creep up, and you've seen the headlines about major corporate layoffs. Now, to make matters even worse, the official data we all rely on is delayed because of a government shutdown. That means the Fed is kind of flying with impaired vision, forced to make a huge decision with an incomplete picture. But here's where the story gets really interesting. This wasn't a simple, unified decision. The vote to cut rates was actually contentious. And for us as investors, that internal battle at the Fed, well, it tells you a lot about how uncertain things really are under the surface. You've basically got two camps inside the Fed clashing. In one corner, you have the doves, like Governor Meterin. They see the weak job numbers, and they want to cut rates even more to get ahead of a recession. But in the other corner, you have the hawks, like President Schmidt. They're looking at inflation and pumping the brakes, saying, whoa, hold on, our job isn't done yet. And this is the hawks' entire argument in a nutshell. Even with the economy slowing down, inflation is still stubbornly stuck above that 2% target. So if you cut rates too much, you risk pouring fuel on that fire all over again. They're walking this incredibly fine tightrope. Do you fight a slowdown, or do you fight inflation? Trying to do both at the same time is almost impossible. So, given all that drama, how did the market actually react? This is where the rubber meets the road for your portfolio. The stock market's reaction was really telling. The S&P 500 basically ended the day flat. The market was just not impressed. The tech-heavy Nasdaq did okay since lower rates are good for growth stocks. But look at small-cap stocks. They actually fell. Why? Because small caps are much more tied to the health of the domestic economy. The market heard the Fed's reason for the cut, a weak labor market, and got spooked. And the signals from other assets were just as complicated. Bond yields actually went up a little, which suggests bond investors don't think the Fed is going to cut a whole lot more. The US dollar got stronger for the same reason. The one clear winner out of all of this? The housing market. And this is that silver lining. Mortgage rates have now hit their lowest point in more than a year. That gives some much-needed breathing room to consumers and to the housing sector, which, is a key part of the economy the Fed really wants to keep propped up. So all of that brings us to the most important question of all. What happens next? And what, specifically, should you be watching? Fed Chair Powell could not have been more clear about this in his press conference. He used this exact phrase, and he was basically sending a direct message to Wall Street. Do not get ahead of yourselves. The Fed is not on autopilot. They are reacting to the data as it comes in. For investors, the takeaway here is crystal clear. You have to watch the data just as closely as the Fed is. Every single jobs report, every inflation reading from here on out is a massive piece of the puzzle. The market is going to live and die by these numbers until the next Fed meeting. And this leaves us with one final and pretty critical thought. You got the Fed admitting the labor market is soft, they're openly divided on what to do next, and they're operating with delayed data. You put all that together, and the potential for a policy mistake, well, it's pretty high. So the question for your portfolio is this: could the Fed's next move, made while flying blind, be the very black swan event that nobody sees coming?